All right, let's go ahead and get started. I'm Brian. I'll be your host for the next 25 minutes or so, and we'll be giving a market recap since the last time that we were together about 2 weeks ago. Fundamentally, not much has changed, but I'll explain that. Let's get through a little bit of the legal stuff and just go through the disclaimer first so you can all see that. Okay, let's go ahead and move on. And like I said, fundamentally, that's what we're going to do first. So here's the outline for tonight. We're going to do fundamental analysis, the 2-week catch-up. Then we'll move into technical analysis, looking at major trends, major area of support and resistance, and then go into some live market examples as well as some intermarket relationships. So fundamental analysis, discussion of current events and what they mean for traders and investors. One way to do that is to go to forexfactory.com, which you can link right through Interbank FX. You can time a lot of those economic releases with CNBC, so it's a good idea, especially with the international news that's going on daily and occurring right now as we speak, basically in Europe. It's a good idea to have some kind of television or live feed going on. Bloomberg is another website that gives great international stories, and then obviously the various news coming, like I said, from your broker and other market sites. So just to show you some of those sites, Bloomberg, there's basically the headline news stories coming out on Bloomberg right now. And then the Forex Factory that I talked about, this is just daily economic activity coming out from governments all around the world. And tomorrow in the United States, we have one number for the most part coming out, which is unemployment claims, which gives us a picture of the job report basically on a weekly basis. But again, I'm not spending too much time here because this economic data has definitely taken a back seat. We'll look at that when we look at equities and prove that basically. But again, it's all international events right now. You know, I call it bail and fail. Bail, markets go down. Fail, markets go up. Bail, markets go down. Fail, markets go up. I'm talking about equity markets, and then obviously the other relationships that we see. What does that do to the currency pairs that you may be trading? So again, I'm not focusing on this too much. I'm paying attention to it, but really, really, really in the background because, again, it's the international news. It's those headlines. So that's the fundamental news is here's the economic calendar. Here's the data coming out from different currencies across the world, but it's taking a back seat to what's going on from government intervention and things like that. And I've been writing about that on my blogs, if you've been paying attention to that you've got to be very, very careful in these markets because nobody knows what's going to happen from 1 minute to the next, from one day to the next. So you can't really hold on to positions for a long, long, long time. Maybe you can hold on to positions if you're using them to hedge and hedge this huge equity move up, but as far as the economic calendar goes, things aren't getting better, things aren't getting worse, but we're just paying attention to, is a government going to bail out a specific country or a specific region or a specific area? So again, that's kind of what we're paying attention to, and that can make for very hectic, very volatile trading. Moves can happen in leverage markets. As you know, 50 pips, 100 pips can happen in a foreign currency pair in the blink of an eye, and if you're an intraday trader trading for 10 or 15 or 20 or 30 pips, you know, you have to be very, very cognizant of that. So the less that you're in the markets, the better off you're going to be. The more you're holding on to things and the longer you're in the markets and the more you're engaging in the markets, obviously the more risk you're taking on to be involved in this quote-unquote event risk. All right, let's move on to the outline here and move into some of the technical analysis. So what are traders doing with this fundamental news that's coming out so fast and furiously, and looking at major trends, major support, major resistance, and again, these intermarket relationships? I think a good place to start will be the equity markets. So we're just going to take a look very quickly at the equity markets. over the past month or so, from early October to where we're at right now, the S&P basically went from 105 roughly, or 106 roughly in that area, to 120 to about 125. So if you do the math on that, it's about a 16% move. And if you count the days that it happened in, it's about 16 days. So we went up 16% in the equity markets in 16 days. I've seen 8% moves, very, very quickly, 10% moves as of late over the past couple of years, but 16% was a major, major move. And more importantly, there was kind of a head fake here because we had a lot of support right down here. We broke through support, and then we had a head fake and came right back up. Not only did we come right back up, but we screamed all the way to the top of the band of this support and resistance band around the 122 level, 123 level, and we broke out to the upside. So head fake here, and then boom to the upside. Is this going to be a head fake? Who knows? A lot of it, again, has to do with international events and things like that. But the next resistance level above here, if we're working from right to left, is moving up to the 135 area. So right now, all we're concerned with is around 125 as far as resistance goes in the equity markets, 135 above that, and as far as support goes, back down around the 110, 111 area. Hard to call this spike down, the support level. It's kind of that common area. So that's the great thing about charting, is it's an art, not a science. Some people will say this is support down at 108 or whatever this low is, and some people will say 111, 112, kind of in this common area. But the bottom line is we've been in this range. August, September, and October, we're kind of in the range. We've peaked out to the upside of it. What does that mean for our currency pairs now? And that's where I'm going with some of these intermarket relationships. And again, if you have any questions, just go ahead and chime in at any time. I'm just checking back frequently again to see if anything pops up. So let's move into our Interbank FX website, into MetaTrader platform here. And again, so let's kind of look at the longer term at some of these currencies here. Here's a daily chart of the pound. Here's the beginning of October, and here's where we are right now. So in the same period that the stock market went up 16%, the pound gained from 1.53-ish to 1.60, so about 7 pennies. What did the euro do over the past month or so as the stock market went up 16%? 1.31 to 1.40, and again, it just seems very, very bullish. You can't keep equity markets down, and you can't keep the dollar basically to rally. You can't get it to rally, so the dollar is weakening. Here it is on the longer term against the Australian dollar. The Australian dollar went from 93 to 105 roughly. Very, very, very strong. So, I mean, that's a massive, massive move. So that probably got the biggest move. Same thing, here's the New Zealand dollar, 74 all the way up to 80 roughly. And then here's the flip, the United States dollar getting weaker. So the United States dollar going from 106 down to parity basically, to even. And then the U.S. Swissy, which is always kind of a little bit differently. But again, the U.S. has lost value against the Swiss franc. So there's your intermarket relationship. And that's why, a lot of people have been emailing me on the Interbank FX Connect, that social site where you can kind of follow people and mimic their trades and things like that. And I tell people, I say, do not follow what I'm doing, because I use foreign currencies a lot to hedge. And so, yes, I'm an intraday trader, and I'd use very, very specific trade setups to trade within the volatility of each day, day after day after day. But I also take the opportunity to say, you know what? This is a massive move up, whether it's the Australian dollar or whether it's the pound. And I'm not sure what's going to happen in Europe. And if equity markets continue to go up, great. And if equity markets drag the pound up, great. But at these levels, I may decide to say, you know what? I think that these are overdone, and whether I'm wrong or right, it doesn't matter. To me, it's not a trade. It's more of a hedge, saying if the stock market does fall off after a 16% gain, the dollar should strengthen. So that's kind of this red bar yesterday as the stock market went down 200 points, and you can see the pound fell off a little bit, but it's come right back up, just like the stock market has come right back up. So we did get a little bit of a down move over the past couple of days. Here is the Australian dollar over the past couple of days, and now you can see it's Thursday morning, and we're starting to trade again in Asia, and whatever's going on in Europe as we're speaking right now obviously is positive, because we've we've gotten back all of yesterday's loss. In the stock market, we went down 200 points yesterday. We went up 160 points today, and the futures are pointing to a higher open. So as long as that stays the same, you would expect the Aussie dollar to go up. You would expect the pound to go up. You would expect the euro to go up right at the top of its range. So these are key relationships that people are using. And again, as a day trader, a lot of you are intraday trading, you can be aware of that. And so you're really only buying the dollar in very, very specific places. So obviously today, if we just look intraday at what happened with the pound, as the pound lost value, basically you're trying to pick up the pound at a cheap place. And again, a lot of this was news driven, but still there was a very, very good trade. I like to use standard deviation trades. And one showed up in the euro today. And when the euro hit a certain price point, I was looking to buy the euro because I thought it was oversold. So I'm trading with the trend. The trend in the euro is up. I'm trying to buy the trend at a discounted price in this very specific location, but I'm paying attention to fundamental news and things like that. And again, I have to have my risk out there. I have to understand that I could lose because all of a sudden some announcement could come out and the euro could get cheaper, the pound could get cheaper, the Aussie dollar could get cheaper, and my day trade trying to buy these currencies at a discount could go against me. So I'm fine with that. That's fine. That's just the trade. I'm either going to have a winner or a loser. I just am trying to make the best educated decision that I can. So that's where those intermarket relationships come in. I'm just looking back at questions. Let's see. So question, is it enough for intermarket analysis between S&P 500 USD? I mean, should we compare? I'm just talking about the S&P. That's a good question. So the question was, can we compare other indexes and entities to the S&P? And so the S&P is obviously a very broad, market index. But if I bring up the S&P here, okay, just take a mental picture of the S&P, and I'll bring up DIA. So let's get the chart of DIA. All right, it should look very, very similar. So there's a picture of DIA. Let's go ahead and look at a picture of IWM, which is the ETF for the Russell. Okay. Very, very, very similar. Big move up all of October. So the point is they're going to have their little nuances. The S&P has a lot of financials. Dow Jones has a lot of those big multinational corporations. And so they'll differ a little bit as far as which one's leading and lagging of these four, the Russell, the NASDAQ, the Dow Jones, and the S&P. They'll always have some that are stronger than others based on what's going on with interest rate policies and things like that. Check this out, all of these pairs, not these pairs, but all of these indexes and ETFs, the S&P, the Russell, and the Dow Jones are kind of about halfway back. If you look at the move down, we kind of went sideways and are about halfway back. Who's the strongest? Very, very easy to point out, the Qs. Check out where the Qs are. They're up at this old resistance from earlier this summer, kind of right up here. So this move up was a massive, massive move up right up to the top. So if we go higher, you would clearly expect the Qs to take out this 59.60 level that had some resistance there, if we keep moving to the upside. So that'll be an interesting level up there. But again, all signs point to the upside. I don't know if that's because there's money on the sidelines that people say is still coming in, that retail, that the retail investor doesn't want to miss out on these moves. I don't know if that's because there's shorts that are stuck. I mean, this is a violent move. Remember, fundamentally, nothing has changed. Things haven't gotten worse. Things haven't gotten better. But because the governments are out there supporting and saying, we'll do it, we'll support you, that's what's fueling this. And anybody who is short, who's paying attention to technicals and saying it's a Fibonacci retracement or it's hitting a moving average, whatever it is, you can throw out technicals right now. You really, really can, because technically your MACDs, your RSIs, your stochastics are saying overbought, and we just keep going higher, 12% up, 13% up, 14%, 15%, 16%. Again, these are unheard of moves, unprecedented in the speed that they're happening. And so again, this is just the stock market. When currency pairs move, I mean, it's the blink of an eye. So, look at these moves today. Look at the Australian dollar. I'll blow it up so you can see it. Just right here, you're trending down, and all of a sudden it takes back that trend right to the upside. And again, I'm guessing a lot of this has to do with international news. I don't know, but that's late in the trading day where there's not much volatility. The stock markets are basically closed around the world. And, this trading time right now is about 4 o'clock East Coast time in New York. So basically Asia's getting ready to wake up and get going. Europe is definitely asleep, but there's meetings going on over there. And our stock market in the United States is closing, and we have a move from 103.40 to 104 even, basically 60 pips in a very, very, very short period of time. So that's what I mean by these news and event risk and these fireworks that you have to be very, very, very careful about. So good question, and you can see those nuances between those indexes that, yeah, they're all working. So obviously the indexes are made up of a lot of stocks. So if the indexes are going up, we know which way the stocks are going. Obviously, again, like I said, there'll be some nuances between sectors. Here I'm going to bring up the financial sector, and is it doing as well, obviously, as the NASDAQ? No. I mean, here's the financial sector that's turned around and come back and done well, but not as high flying, obviously, as the as the NASDAQ and the tech and the services sector. Another one, the commodities really, really got beat up. Let me see if I can find it here. So the commodities really got beat up. They really moved down, and now they're starting to come back up, but they've been weaker overall than a lot of other sectors. So that's the kind of stuff that you have to be aware depending. That's why I always, when I work with clients, I need to find out who they are, what they're holding, what do they have available to trade, what do they have at risk. So if they're in all commodities, then basically we might be doing something different than someone who's right now, than someone who's in all, tech or something like that. So that's what I need to find out is where do people have risk, whether they're in gold and they're buying physical gold or the ETF, GLD, whatever it is, whether they have a large equity portfolio, whether they're mutual funds, whether they're just interested in day trading. Everybody out there who I'm speaking to, everybody listening tonight, you guys are all in different places. You guys all have different account sizes. You have different amounts of time to focus on the markets. You have different goals, different risk tolerances. You've got to make sure that you're aware of that. Someone was kind of, asking me some questions today on that Interbank FX Connect on the social site, and I can bring it up right here so you guys can kind of see. And someone said, I want to follow you. And I said, please don't follow me because I don't know your situation, and you have no idea what I'm trading for or why I'm trading. And sometimes I'm doing intraday trades, and sometimes they're long-term trades. And I said, please don't do that. So you guys have to be very, very careful following people because you might not know why they're putting on trades, and they might have totally different timelines and timeframes for trades than what you're comfortable in. They might have totally different account sizes, so they might be able to hold on to things a lot different. So, this is a great site and great information to follow. And I'll give you my kind of tagline if you want to follow me, but just be very, very careful. All right, so going back, so kind of the long term, I think we understand what's going on. Shorter term, basically we topped out a little bit, but it's hard to say that we're topping out. So we can run through these pairs a little bit and see what's going on. So here's the pound basically, and what I've been doing, I'm just going to put this on so we can see the past few days, couple weeks. What I've been doing again as a hedge is saying I want to buy the dollar when we're overextended in the pound to the upside, and try and hold on a little bit and take some profits. And like I said, when we dip down, that's when I'm trying to buy the pound. So you can see that if you're buying the pound, you're going with the trend. You're better off. So remember, number one, trend is your friend. Number two, support and resistance. So right here, I want to be a buyer of the pound unless I'm using the dollar in a really weak place, the U.S. dollar, to hedge. So overall, if I'm trying to make intraday trades and things like that, for the most part, I'm trying to be a buyer of the pound at a discounted price. And that's the case for all of these currencies against the United States dollar. You're basically selling the dollar for most of your trades because that's been the trend. So that's the number one, is trend is your friend. Until we hear differently from Europe and things like that, until other fundamentals take over, that's the trade. It's very, very easy. Same thing in equities. You want to be a buyer of equities basically at any dip. And that's what I talked about today in my blog, is if equities do come back down, and let me bring them back up. So we'll just go to SPY just again because that's the broad index, but they're all pretty much similar as we saw. If S&P goes from 125 down to maybe 120 or in this area, again, might be looking to get bullish because I'm getting a discounted price in an uptrend. Again, fundamentally, I'll have to decide what do I want to buy, what sector, how much, do I want to sell puts to get into it, do I want to buy the stock outright, do I want to buy calls? All depends on how bullish I am in my time frame for the trade. Lots of different ways. That's why I love options, is lots of different ways to get bullish, or at least neutral to bullish. I don't necessarily need it to go up to make money if I'm selling puts and things like that. So that's the nice crossover, is understanding options, because they can make money in sideways markets, they can make money in bullish markets, they can make money in bearish markets. So having that crossover for people with large portfolios, buying options gives you very, very limited risk, because it can't go forever. You can only lose what you pay to get into that trade, versus a foreign currency pair, as you know, can run forever in one direction. A future can run forever in a direction. A stock can run forever in a direction. But options have limited risk. They're a very, very good tool to add to your toolbox if you have a large equity portfolio of mutual funds and retirements and IRAs and things like that. That's something that is a must for my clients. They've got to understand that. All right, so let's go back to the outline here. So technical analysis, I think we were able to dive into that very, very nicely, and seeing those intermarket relationships and seeing where the major trends are, support, resistance, kind of taking a look at some of those examples. So to review, fundamental analysis, be very careful. It's hard to analyze what's going on fundamentally. I don't see this kind of atmosphere changing anytime soon. So in 2 weeks, we'll still be kind of talking about the same things with these news events and fireworks and things like that. Technical analysis, we know the trend is up in equities. We know that the trend is down in the dollar, and that doesn't seem to be changing, at least tonight, through tomorrow for sure. I'll say that. I won't say for the next few weeks or few months on that one. Things could totally change on that in the next 2 weeks. That's what will be fun, is to see what are the traders doing with all this fundamental news. That's our job, basically, and the people who are making money are obviously using the charts very, very well in this atmosphere. And again, those intermarket relationships, like I say, whether you're day trading, whether you're trading for income, whether you're protecting your portfolio, they're crucial. They provide you these really nice trading edges. Again, bottom line is you've got to know who you are. You've got to have proper account management. Don't risk too much of your account, and you've got to have good trade management. Don't blow a lot of your account on one trade because you get emotional. You stick to something that's obviously not working out, or you get caught in one of these news events. Be very, very, very careful. Next webinar, we'll be talking in 2 weeks, same time, 9:30 p.m. Eastern. So it'll be Wednesday, 2 weeks from now. As I said, very, very similar topics. I'll be able to answer your questions as they come in. Education recordings, all of my recordings are on the Interbank YouTube website. They just posted today the webinar from a couple weeks ago. Use your broker for Forex. I post basically every day there on their trading edge right here, dailyforextradingedge.com. My own blog is down here at the bottom, but again, it's pretty much the similar information. That's my email if you want to email me any questions personally about your situation. I've been doing a lot of interviews for Interbank FX clients where I basically run through, give them kind of my 16 years of unbiased opinion of what's achievable for them, and kind of hones them in and refocuses them, because a lot of people come in all over the place and they're watching all these different people trade and they're hearing people talk about different things, and that's the number one thing. You can't really be profitable unless you know what you're trying to achieve as an individual in your situation. A lot of people need help identifying that, so I'm happy to provide that help. If you want to follow me on the Interbank FX Connect website, the Locals Take is my handle, if you will. So that's it. Thank you very much for checking in tonight. And again, this will be on YouTube in the next week or so. You know how to get a hold of me if you have any questions. I'll talk to you daily on the blog and in 2 weeks on the next webinar. Thanks.